Ron is an expert in mergers and acquisitions, exit planning, and capital formations in the green industry. Ron is a frequent author, speaker, and consultant in these areas. He is the president of the Principium group. Principium is a mergers and acquisitions advisory firm, and it focuses on servicing clients in the green industry, and that includes lawn and landscape companies and related businesses. Ron is a recognized industry expert. He's the author of 2 books titled Green Exit, Exit Planning for Lawn and Landscape Business Owners, and How to Sell Your Green Business. Ron is also regularly quoted in industry publications, including Lawn and Landscape Management. He had an article entitled Knowing When the Time is Right, published in October 2011 issue of Nursery Management. He serves as the editor of the Green Industry Merger and Acquisitions News. It's a monthly electronic newsletter, and it tracks acquisition activity in the green industry and provides some relevant information for business owners. Ron's also an adjunct professor in the MBA program of Christian Brothers University, where he teaches courses in entrepreneurship. He's taught classes at the University of Central Oklahoma and Oklahoma State University, and he's developed and taught numerous continuing education courses, including having served as course manager in the professional development department of KPMG. And for some of his civic endeavors, Ron's a long-term member of the executive board of the Chickasaw Council for the Boy Scouts of America and on the board of directors of the Episcopal Diocese of West Tennessee. Ron holds a bachelor's and a master's degree in accounting from Oklahoma State University and is a CPA. So now we're ready to get started. Right now, let me introduce the presenter to everyone. Ron?
Thanks, Chris. As Chris mentioned, our topic today is acquisitions as a pathway to growth for landscape contractors. Acquisitions can be an important opportunity for green industry businesses to achieve their growth objectives. The process of going through acquisitions can, however, be confusing and foreign to a business owner. Our goal today is to help demystify the acquisition process and offer some insight as to how acquisitions can be used as an effective tool. We will cover a wide variety of topics that we think are of greatest interest to green industry business owners, but we'll try to also address your questions before we finish. We're going to discuss the relative merits of organic growth versus acquisitions, how to identify acquisition targets, valuation, due diligence, financing acquisitions, the importance of the integration plan, some characteristics of successful acquisitions, some mistakes to avoid, most of which we found, a couple of case studies, a little bit more about our company, and have some time for questions and answers. I'd first like to discuss the topic of whether organic growth or growing by acquisitions is a better strategy. Needless to say, it depends on the circumstances. Organic growth makes sense if you are growing, where you can stimulate growth at a rate that meets your objectives, and if it can be achieved at a reasonable cost with manageable risk, and if your timetable permits it. However, successful companies are sometimes cocky about their ability to grow organically, and as a result can take on way too much risk and miss out on opportunities. Let me give you an example. Before the recession hit in full force, I knew of a landscape services company that had been extraordinarily successful with organic growth. They charted out a growth strategy that included opening a number of branches to establish themselves as a dominant provider statewide. They added 4 new branches on top of the 3 they already had. In opening those branches, they leased facility space, bought vehicles and equipment, and hired additional personnel to staff the branches. Unfortunately, almost as soon as the branches were in place, the depth of the recession became apparent. They were essentially stuck with facility leases, equipment, and personnel that they did not need as organic growth slowed dramatically at their original branches. New business in the new branches was slow and extremely difficult to develop. The company did survive, but it was a major challenge. If this same company had launched their statewide strategy with acquisitions, there's a good possibility that those new branches would not have been nearly the drain on the company that the startup branches were. This might have also left the company in a stronger position to take advantage of additional opportunities as a more dominant player in the market. Acquisitions can make sense in several situations. When organic growth is not happening, when there's a need to reach critical mass more quickly, when the business is seeking to grow geographically without incurring startup losses, when the business is seeking a solution to important operational issues or personnel issues, and of course when extraordinary opportunities present themselves. In developing an acquisition strategy, it's important to clarify your objectives. Some of the objectives of an acquisition strategy may include reaching critical mass, growing market share, expanding market territory, expanding service lines, cross-selling revenue synergies, selling existing services to new customers or selling new services to existing customers, cost reduction, cost synergies, eliminating duplicate costs or achieving economies of scale, enabling an exit strategy, adding a dimension to the business that will make it more desirable as an acquisition target itself, and adding quality people. How then can you identify acquisition targets? There are a number of ways to identify businesses that are for sale, such as the online databases BizQuest and BizBuySell.com, along with many others. Those two are particularly large. There are also many others that are national in scope and some that are regional. At any point in time, however, there are usually relatively few businesses that are listed that are likely to meet your acquisition criteria. However, it's possible to use research materials and industry information to identify businesses that may meet your acquisition criteria. You can reach out to them by telephone or mailings to inquire their interest, or you may use a third party to assist you, maintain confidentiality, and make contacts that would be difficult for you to make directly. One of the concerns about reaching out in a mass way is that you may wind up dealing with businesses that are curious about the process rather than businesses that are likely to sell, potentially wasting valuable time and resources. A merger and acquisition advisor may be able to help you avoid this situation. A merger and acquisition advisor or a business broker may also be able to help you identify potential targets as well as assist in negotiations. A particularly good way to identify acquisition opportunities is to maintain relationships with others in the industry, including through the national and state trade associations. Once you identify a target, you'll soon have to address the issue of valuation. Businesses in our industry typically sell for between perhaps 2 and 4 times EBITDA, earnings before interest, taxes, depreciation, and amortization, sometimes lower, only occasionally higher. This is a very broad range, and where a business will fall within that range will be determined by a combination of value drivers and market conditions. It's important to remember that the consideration paid to the seller is not the only cost of the acquisition. There are transaction costs, working capital requirements, and integration costs. Some of the value drivers that will affect a landscape company's value include its record of profitability, its growth prospects, the portion of its business that represents recurring revenue, the systems that it has in place. And when I say systems, I don't mean simply computer systems, although that's a part of it. It's how do you generate business, how do you operate the business, how do you ensure quality control, physical assets of the business, the reputation of the business and customer satisfaction, the quality of the customer base, the quality of management, the quality of employees, and the belief that employees and management will be able to be retained after an acquisition, the quality of the records maintained, and the independence of the business from the owner, meaning how dependent is the business on the owner's presence. Does it all revolve around that one person? In our experience, there are almost always more buyers and sellers in the marketplace. That may seem counterintuitive, but I will tell you that just because there are more buyers and sellers does not mean that it is a seller's market. The reason that there are more buyers and sellers, in our judgment, is twofold. First, independent business owners, like yourselves, started their businesses because they enjoy the independence, rewards, and perks of business ownership. They're not likely to give that up lightly. Secondly, the value of their business to a new owner is often not as high as it is to them as the existing owner. It simply does not make sense to sell from an economic perspective in many cases. Some of you may have discovered that when thinking about selling your own businesses in the past. Unfortunately for buyers and sellers, this phenomenon does not make the process any easier. There are many buyers who would consider an acquisition if they could only find a seller that would sell for a reasonable price. There are also many business owners who would sell if only buyers would offer a reasonable price. Unfortunately, there are very limited circumstances in which sellers' expectations intersect with buyers' evaluation of fair market value. In addition, financing sources are always looking over the shoulder of buyers to make sure they use a disciplined approach to valuation. After a tentative deal is negotiated, it's time to begin the due diligence process, which lasts until the transaction is closed. There are several aspects to due diligence. One often thinks of legal and financial due diligence, but operational and cultural due diligence are also important. Examples of operational and cultural due diligence include things like, does one company use salaried salespeople and the other use a commission program? Does one company require salespeople to wear a coat and tie and the other wear polo shirts? How do employee benefit plans compare? Do one company's clients pay in advance and the other at the end of the month? I want to come back to that one in a moment. It may sound kind of silly, but does one company use Chevys and the other Fords? That may be a bigger issue than it sounds like. Does one company use pickups for its crew and haul its equipment with trailers, and another company use box trucks? Do the companies have similar customer service philosophies? The list goes on forever. There are two distinct outputs from the due diligence process. Is this a transaction that we want to proceed with? And what issues merit special attention in developing the integration plan? I wanted to go back and comment briefly on the question about billings. Do one company's clients pay in advance and the other at the end of the month? That's a question that people a lot of times don't pay any attention to. Many maintenance companies, bill at the beginning of the month and collect during the month, and by the end of the month, almost all their revenues for the month are collected. Others bill in arrears. That is a huge difference in the value of a company. And I just recently had an experience where a buyer discovered that a seller was billing at the end of the month when they thought they were at the beginning of the month, and it represented a perhaps $100,000 difference in the amount of capital that the buyer was going to have to come up with, because instead of expecting to bill at the beginning of the month for those customers, he wouldn't be able to, and he'd have to put in the capital to pay the bills, pay the labor costs during the month until the billings came in. So that's an important factor in example determining where a company ought to fit on the value range might be that issue in itself. As the due diligence process proceeds, lawyers are then released to begin drafting documents. Let's talk about financing acquisitions for a moment. There's a great deal being said and written about how hard it is for small businesses to get financing for expansion. Although the options are fairly limited, there are options. SBA loans are loans made by commercial banks under the federal government's Small Business Guarantee Program administered by the Small Business Administration. Loans made under this program are 75% guaranteed by the U.S. government. SBA loans are often used for acquisitions and are widely available to creditworthy borrowers. Of course, SBA loans are not the only opportunity. A buyer can use its existing resources and credit lines. In addition, many, if not most, business acquisition transactions involve some element of seller financing, typically payable in monthly installments over 3 to 5 years. While I don't think I've ever had a single seller come to me saying that they wanted to provide seller financing, it's often a very practical alternative that provides a good result. The seller will often come closer to realizing his or her valuation expectations, and the resulting financing may be a good investment while providing a favorable tax result. One of the very most important steps in the process is the development of the integration plan. This plan outlines who is going to do what, when, in connection with integrating the acquisition. It's both a planning and accountability document. In some cases can be quite complex. The purposes of the integration plan include bringing the businesses together without losing control, retaining the people you want to keep, retaining the customers you want to keep, realizing the cost synergies you expect and on which you built your acquisition case, and realizing the revenue synergies and growth opportunities you're seeking. An integration plan can be quite detailed in some cases. I remember about 3 years ago, Massey Services acquired Middleton Pest Control in Florida in a transaction that increased Massey's size, I don't know, perhaps 50%. It was reported that the detailed integration plan ran over 100 pages. Successful acquisitions share some common characteristics. They fit into the acquiring company's strategic plan. They make sense on paper. They have reasonable values in the circumstances. They're wins for both the buyer and the seller. They involve a clear integration plan. The team executes on the integration plan. And unforeseen problems, which are undoubted to occur, are quickly identified and resolved. Let's talk about some mistakes to avoid in the acquisition process. The first one I put down was going cheap. And what I mean by that is choosing an acquisition target that you know that you can get at a low valuation, as opposed to focusing on ones that will meet your objectives. Those are often not the same thing. Failure to focus on the human aspects of the acquisition. Being overly optimistic about synergies and post-acquisition performance. Failing to have a strategic purpose for an acquisition. Inadequate due diligence. And when I say inadequate due diligence, I'd say that has two parts. One is not doing enough due diligence to find out what you need to find out, and the second part is failing to act on things that you did discover during due diligence. Making too many concessions to get the deal done, and failing to prepare an integration plan before finalizing an acquisition. Some mistakes to avoid after a deal is done. Number one, not following through on the integration plan and not making adjustments to the plan when necessary. Failing to take action to realize the synergies upon which the acquisition case was built. And an example of that, I mean, if you build the case based upon consolidating 2 locations and then convince yourself after the acquisition is done that it's not necessary, you're very likely not to realize the benefits you expected. waiting too long to address issues that do develop during the integration process. Let's take a look at a couple of case studies. Our first case study I will call a spectacular success. In this case, the acquiring company was about a $750,000 company focused on residential service. It's based in a small town with a population of about 100,000 people. The company was profitable, but much lower than the company's expectations. Its net margin was about 10%. The target company was also about $750,000 in revenue, also with about a 10% margin. It was located in another small town with a population of about 35,000, about 100 miles south of the acquirer. The integration plan involved closing the target's administrative office and providing management oversight by relocating one of the acquirer's key managers. No management was added in the deal. Processes and procedures were standardized, mostly based on the acquiring company's processes. The result, nearly all business was retained. The combined company has about $1.5 million in revenue and a 15% margin. It was a big win. I'm going to call the next case study an epic failure. The buyer was a fairly large company which had minimal operations in the target's town. The target's business was about 65% residential and 35% commercial. Negotiations and due diligence went well and the transaction closed. The only problem was that 6 months after the deal closed, every single commercial account was gone. You heard me right. Every single commercial account was gone. How could that have happened? The buyers had not paid enough attention to that commercial book of business. It turns out it had been built essentially 100% by the commercial manager. He was not involved in the sale of the business. In addition, he had been vaguely promised an equity interest in the business, a promise that had long been forgotten by the owners, but not by him. When he found out about the sale, he was really angry. He quickly started his own company, even though he had a non-compete, and he called on every single client and recruited them. Even though they theoretically had some legal protection, this acquisition proved to be a total disaster. In summary, acquisitions can be a successful opportunity to grow a landscape contractor's business in some cases. And some of the keys to success include developing a strategy and sticking to it, developing and implementing an effective integration plan, and avoiding common mistakes. At this point, we'd like to open it up to questions. We've got a few questions that have come in already, and we'll address those, but you can submit additional questions if you like via the question thing on your screen. The first question relates to valuation, and when we talked about valuation, we talked about a range of multiples of EBITDA, earnings before interest, taxes, depreciation, and amortization. The question is, how is that calculated? Well, on its face, it's a pretty simple process. You take earnings and add interest, taxes, depreciation, and amortization. It's really not quite that simple, though, because it does require analysis and needs to be adjusted for non-recurring items and discretionary expenses of the owner, expenses that would not be applicable to a new owner or would not be necessary for a new owner. And that's usually called adjusted EBITDA. The second question we have here is what precautions do you recommend when making an asset purchase, and what are the pros and cons of an asset purchase versus outright acquisition? Well, first of all, I'm going to assume that by outright acquisition, that means an acquisition of the stock of a company as opposed to its assets. It is pretty rare to have a stock acquisition. Almost all acquisitions are done as asset purchases. It's done that way for several reasons. One is that an acquirer rarely wants to take on the liabilities of the seller. And it's not because of simple liabilities, it's because of more complex liabilities, things like possible tax liability and especially in our industry, environmental liabilities that may occur if there's been mishandling of fertilizer or weed control products, for example. In a few cases, transactions do get done as stock purchases. That usually happens in cases where the seller is a C corporation, a business corporation that does not elect treatment as a pass-through entity or S corporation. And in those cases, it is a seller may be exposed to double taxation if they do enter into an asset purchase agreement. And what I mean by that is if they sell the assets out of the C corporation, then the C corporation will have a gain, theoretically at least, and will have to pay taxes as a corporate tax-paying entity. And then when those proceeds are distributed to the owners as a dividend or compensation in some form, they'll be subject to ordinary their individual income taxes as well. And especially in states and municipalities that have a significant income tax burden on top of federal income taxes, it can be a deal-killing thing. And there may be ways to structure a transaction that provides a level of support to the buyer that offsets the negatives in terms of liabilities and tax consequences. From the buyer's standpoint, the tax consequences can be pretty severe of doing an asset purchase, a stock purchase also, because they're not able to depreciate the physical assets that are acquired. Richard, do we have any other questions that have come in? Richard Helling, another of our associates, is with me today, and he's handling the questions. And it looks like we don't have any more. Feel free to email us with any follow-up questions you may have as well. I'd like to take this moment to tell you a little bit about our firm, the Principium Group. We are specialized exclusively in green industry transactions. We're involved with mergers and acquisitions, exit planning, and capital formation. Our home office is based in Cordova, Tennessee, which is in the Memphis area, and we have an affiliate, Chris Martin, who's based in the Philadelphia area. One of the things we try to do as a firm is to provide a great deal of resources for green industry business owners. Among those things are publishing green industry merger and acquisition news, which probably most of you already receive. If you don't, let us know. We'll add you to the list. That's a monthly electronic newsletter that provides information for both buyers and sellers within the industry and attempts to track publicly reported transactions that occur. We have a companion website to our primary website, which is really a blog, which also tracks information on day-to-day activity, day-to-day transactions and information related to buying and selling businesses in the industry. We published a couple of books, as Chris mentioned earlier, Green Exit and How to Sell Your Green Business, and we're putting the final touches on a new book, Acquisitions as a Pathway to Growth, which has the same name as this webinar. This webinar is a part of our theme for this year that will culminate in the publication of that book just prior to the Green Industry Conference this fall. We do webinars like this one. We have podcasts. We try to get involved with speaking engagements at industry events and write articles and prepare special reports. So we try to provide information wherever people within the industry are looking. In terms of our professional services, our typical engagements include seller representation, buyer representation, exit planning engagements, business valuation engagements, strategic planning, and consulting. And if any of those are on your agenda, we would welcome the opportunity to visit with you. We serve clients from coast to coast. You'll be receiving a follow-up questionnaire, which will have 3 parts. We'll ask for some information in terms of an evaluation of this webinar. We're relatively new in the webinar business and are putting a lot of energy in trying to do the best job we can, and welcome your feedback. If you have follow-up questions, you can submit them there, and we'll get back with you in writing or by phone. And if you have any recommendations for future webinars you think would be of interest. In terms, we are going to be putting on at least 1 webinar, if not 2, per month for the foreseeable future. This particular one was kind of an overview of the acquisition process, and we're going to be doing some that get far more in depth in various topics that we discussed. As a special thank you for participating in the webinar and responding to the follow-up questionnaire. Everyone that responds to that follow-up questionnaire will receive a free copy of the new book, Acquisitions: A Pathway to Growth in the Green Industry, which will be published in September. Thank you very much for your participation today. We've enjoyed it. We hope it's been meaningful to you. And if we can do anything for you, please give us a call or send us an email. Thanks again.